Good afternoon to all of you. I request everyone to be on mute for smoother transition and better clarity of the audio. And a very warm welcome to this insightful webinar on corporate taxation. My name is Ankita Mukhija. I'm a chartered accountant and a certified fraud examiner, and I'm truly honored to be your moderator for today's discussion and navigate the complexities of corporate taxation. With the introduction of corporate tax, business houses need to be ready for the compliances in its financial structure. To enlighten on the readiness for corporate tax and what kind of automation can be done in the financial system, we have two eminent speakers today with over 2 decades of experience in audit and taxation services with Big Four Consulting and large MNCs. I am glad to introduce Mr. Manish Saraf, who is a chartered accountant with over 20 years of experience in audit and taxation services. He has worked previously with Deloitte, PwC, and many other multinational business houses. Over the last 7 years, he has been in UAE serving the clients in VAT compliance, health checkup, and corporate tax assessments. He has conducted several webinars, seminars on the corporate tax topics. Alongside Manish, we have Pradeep. Pradeep Gurjan is also a chartered accountant having more than 18 years of experience in risk management and internal audit. His proficiency extends to implementing RPS solutions, leveraging Power BI for dynamic data visualization, and utilizing Python and SQL for advanced analytics. With expertise in generative AI, Pradeep is at the forefront of innovative solutions, optimizing business processes and enhancing decision making capabilities. His strategic approach in integrating these technologies showcases a unique ability to drive efficiency, automate workflow, and derive actionable insights across diverse industries, marking him as a forward thinking professional in the technological landscape. I encourage each one of you to actively participate, ask as many as questions you have, and take full advantage of the expertise and knowledge that our speakers bring to the table. Without further ado, I would like to hand over the reins to our experts. Manish, the floor is all yours. Thank you very much.
Thank you, Ankita, for this introduction. Good afternoon, everyone. So today on the session, we are going to touch upon some of the nitty-gritties in the corporate tax. And now with January 24, most of the companies would have this applicability coming in these business houses, how they need to be ready, what kind of changes they need to bring in their financial system, the structure, and how the automation can help them and that changes. So we're going to talk about that. So our presentation is compiled from the Ministry of Finance, the federal tax authorities, their circulars, their guidelines. So it's not be interpreted as law. We have our own analysis based on which we have presented this, and we have tried to cover as many aspects from those guidelines and circulars being issued by the ministries time to time.
Manish, your sound is not clear.
Yeah. So now what we're going to cover today is on the basic applicabilities of the corporate tax to the different business houses, the basic concepts about it, and how what kind of changes in the structures in the financials that would be required based on the different exemptions or disallowances of the expenditure, and then what kind of transition is required for your readiness and what kind of changes is required in the financials. What are the transition provisions? We're going to cover about it. And also one of the key aspects is with respect to some of the transactions within the group companies. There are group companies within UAE, how those transactions has to be reported, what kind of documentation is required, that we'll talk about. And then, of course, the financials, how the accounting record keeping has to be maintained, what kind of documents are required, what changes are required in that. And then the overall, the corporate tax registration, the administration process, the return filing process, and the other compliances to that. And then, of course, the automation, what we can do in the automation, how those changes can be built through the automation. So as we know that the corporate tax law is effective from 1st June 2023, but it is depending upon the financial period each company, these businesses have. So if the company has a financial period from 1st July to 30th June, so for them it is 1st July 23 to 30th June, and then the tax one-time annual return is filed 9 months thereafter, which is 31st March 2025. And as most of the companies would have their financial period Jan to December, so the first period is 1st January 2024 to 31st December 24. And 9 months thereafter, the return filing is 30th September 2025. So it is a one annual return to be filed, while in VAT, we have also, and it is a quarterly return or monthly based on the turnover the company has. But in the corporate tax, it is on the business income and it is one annual return. So where do we find to see where is a financial period being described? It is in the memorandum of association. If you see your memorandum of association, then you will see the company financial period is mentioned. In this particular case, it is 1st March till 20 is the financial period. And as we know that the tax rate which is there in the UAE is based on the is the income based on the income threshold. So up to 375,000 of the business income, it is 0% tax, and beyond that is a 9%. So if a company has a business income, it is a net profit of 400,000. So they would be paying 9% tax on over and above 375,000. That is 25,000 is the amount. So 400,000 minus 375,000, it is a 25,000 on which they would be paying 9%. Now, certain entities which has a presence in a free zone, and if they meet certain specific criteria for the qualifying free zone person, then they would have a qualifying income on which they would have 0%. And other than that, the non-qualifying will be 9%. So those conditions has to be looked into, those activities has been looked into whether they are fulfilling those criteria, which is a separate detailed topic which may cover some time later. But as of now, we are going to talk about how we are going to get ready about in general for the tax readiness in 2024. So as I'm running through those pointers, you can just raise your questions, whatever you come across, and we will take up during the end of the session, whatever queries you have. So this is a general overview with respect to the taxable person. A taxable person could be either a resident or a non-resident, and a resident person is one who could be either incorporated in the UAE, like you have LLCs companies, the private companies which are there, which would have presence either in the mainland or the free zone. So they are taxable. So they're earning their income from UAE, so they get taxed in UAE. Now, those companies which could be incorporated outside UAE but managed and controlled from UAE. So a company which is like LLC company A has a presence or has a business in Singapore. And also the decision making and the control is from the UAE. The key management person is sitting out of UAE. So decision making on how the business has to be run or operated, strategic decision making is happening from UAE. So the income earned from the Singapore entity of the company A in UAE, LLC company A, that income will be taxed in UAE. But then there are certain business provisions need to be looked into it, which is that depending upon the tax treaties, they would have it. So whatever tax is being paid outside UAE will be deductible in the UAE. And now the natural persons are also taxable in UAE, but then if only when they are doing a commercial activities as a business house would be doing it. So if someone is doing a freelancing business or consultancy, so that earning made by that natural person would be taxable. But there are certain categories of income which a natural person would not be taxable upon. So that is like a salary income that is not taxable in the hands of the individual, and as well as the rental income being earned by the individual. If the property is owned by the individual, that rental income is also not taxable. And then income is also earning certain activities which doesn't require a specific license. Say for most of the people would do a share trading activities, the income or gain, the loss is the gain in that share trading is not taxable in the hands of the individual. Now, may I request everyone to be on mute? Now, in terms of other, is a non-resident person. The non-resident is the one who has a setup, who has a residency outside the UAE and doesn't have any physical presence in the UAE, but is operating a business through a permanent establishment So permanent establishment means it could be in the form of branch. A company which is in electronic trading has a branch in UAE and is distributing its goods to that particular branch. So that also get taxed in the UAE because it is earning that income from UAE. Now, a company which has formed a subsidiary in UAE, a company parent company based out of India and having a subsidiary in UAE, that doesn't come under the permanent establishment definition. That would be a resident because the subsidiary is a resident having a proper existence in the UAE. So that will be taxed under the category of resident. Now, even a person, if a business outside UAE, like in India, doesn't have a establishment or branch, but it is deriving a UAE source income. That means he has an agent who's working for him in distributing those electronic items in the UAE. Then income, even that earned by him, will be taxable in the UAE. And then another category is having an access in the UAE. That means there is a specific case which has been recently being announced by the authorities is with respect to the commercial properties, a non-resident having a commercial property in UAE and earning income from that get taxable. So any kind of sources, the whole purpose is any kind of source of income generated from UAE will be taxed in the UAE. So now we look at other is how what are exempt income allowed and disallowed, because this will have an impact on your financials, how that has been structured. So maybe certain items currently might not be allowed, disallowed, but you are calculating your accounting income based on that. So we look at what is that. So now certain exempt income, one of them is a dividend. So dividend received by an individual from a judicial person. That means a judicial person is a registered entity, LLC company. A is LLC company. A is distributing dividend to any individual resident person. Even another judicial person can receive that dividend income. So company A is giving distributing the dividend to company B, then the company B, which is receiving that dividend, will not be taxable. And the reason is that company A is already paid tax on that profit because dividend is distributed after the profit, which is taxed. So it will not get taxed again in the hands of the individual or in the hands of the judicial person, which could be company LLC, B LLC, who's receiving the dividend, will not be taxable. Then the second category is participating interest in a foreign judicial person. So a dividend received similar, like, if a company A has invested in company Z in Singapore, and then they are receiving dividend from that Singapore entity in UAE, then it will not be taxable. But then there are certain criteria, which is basically that company A LLC, which has invested in Singapore company, should have minimum 5% of the holding of that company where it has invested in Singapore. And as well as that holding should be more than 12 months period. If that holding is for more than 12 months period, then the dividend which is received from that Singapore entity will not be taxed in UAE. And the other third one is with respect to any other income from that participating interest, which could be in the form of capital gain or losses or foreign exchange gain losses, anything which is happening, which is being there as an additional income received from that foreign entity will not be taxable, provided it qualifies under the participating interest. May I request everyone to please mute? Then income derived by a non-resident person by operating an aircraft on the international transportation. So a non-resident person who's operating the aircraft, because aircraft or ship is an international jurisdiction area, which doesn't fall to a specific country. So that's the reason that is not being taxed. And similar provisions would be there in other entities, other countries also. Then it won't get taxed. It will be an exempt income. And then the fifth one is income of foreign permanent establishment. So the foreign permanent establishment means like we have permanent establishment in UAE who's a non-resident company. India company has a presence in UAE through a permanent establishment. Similarly, a company in LLC company would have a foreign permanent establishment outside in UAE, that is in Singapore, they would have a branch. So any income earned by the branch will not be taxable in UAE, provided they also have the 9% tax rate in that country. Then certain deductible expenditure, the whole purpose is that it should be pertaining to the business. the business they are carrying out. So if it's electronic trading company in UAE, so whatever expenditure is being incurred for that business will be only deductible, and it would be applicable from the financial period for which the tax is applicable. So from 1st January 2024, if a financial period is Jan to December, and from 1st January 2024, the tax is applicable. So any expenditure being incurred from January till December 2024 only will be deductible. Say for example, a company had any particular services provisions, like car rental services has been taken for the business, and it was done in December 2024, and the invoice is received in January, and the payment in January 2024, and payment is also made in January 2024. So will that expenditure be deductible in the year 2024? That won't be deductible in 2024, because that was pertaining to December 2023, the last year, where the tax was not applicable. So that expenditure cannot be deducted on 2024, following the accrual principle concept. And then the second is not in capital nature, because capital nature, say for example, a company is buying a car for its business or buying any printers or other asset items. Those are deductible as a depreciation, because throughout the useful life of the asset, based on the IFRS principles, I know that will be deductible as a depreciation expenditure. So the amount expended for buying that particular car or any other asset, that will not be deductible as one go. It will be split over the useful life of the asset as part of depreciation expenditure in the accounting income. And then other is with respect to not exempt income. So now related to exempt income, so like dividend which is being received, that any expenditure pertaining to the dividend will not be deductible expenditure, because that dividend income is an exempt income. So if, for example, what could be an expenditure pertaining to dividend income is like if you have borrowed the fund, if you have from the bank borrowing, you have made an investment on that fund on the company in Singapore, and the interest component being paid on that particular borrowing from the bank for that investment, that interest expenditure will not be deductible because it is pertaining to that exempt income of dividend. So now, what are those non-deductible expenditures which cannot be deducted? One of them is the donations. But if the donations is being made for a qualifying public benefit entity list, those are being announced by the authorities, FT authorities, or the Ministry of Finance. Those only on those donations that expenditure can be deducted. But if the donations or grants or gifts are being given other than that, that won't be deductible. The other is input value added tax claimed. That will not be deducted, because an input value added tax, which is already being adjusted against the output VAT, you cannot go and deduct that. But certain expenditures, where, so now, like if you talk about fuel expenditures, certain expenditure or telephone expenditures, the value of input is very small. Value added tax, like 100 is the value of your telephone bill monthly for individual employee, and then 5 is the amount of the VAT amount. And if we don't keep a track of that small value added input tax, then we cannot deduct that as an expenditure, because that is a recoverable VAT from your output. So anything which you have, which can be claimed from your output VAT, and if you're not tracking it, then that expenditure cannot be deductible. But if any expenditure which is not allowed as a deductible under the VAT, which is not allowed to be recovered from your output VAT, that can be deductible expenditure. And then other is the bribes and the illicit payments. That is, of course, is a non-acceptable payment which doesn't promote. So these are not a deductible expenditure. Then with respect to the entertainment expenditure, it is limited to the 50% of that expenditure being incurred. So suppose a company generally has a annual event being organized for their employees. So up to 50% of that expenditure, or it could be even organized for your your partners, your the suppliers or the vendors or other channel partners. So that amount, will that be deductible? It is 50% of the expenditure being incurred for your customers, shareholders, suppliers, or business partners. It could be in the form of meals or any kind of club fees or any transportation being incurred for your partners. So that 50% is only can be allowed. Suppose 100,000 has been incurred for promoting a business through shareholders or the business partners. So 50,000 will be allowed. Now, if that is pertaining to the employees, will that be allowed as 100%? So I was mentioning about the annual event being organized for the employees. If 100,000 has been incurred, so that is pertaining to the employees, then full amount can be allowed as a deductible expenditures. And then what other is with respect to the related party loan, which is without a substance. Now, related party, that means the shareholder has given a loan to the company and the interest amount is being paid on that. So substance has to be proved. That means that loan which is funded by the shareholder is not for withdrawing his own capital or distributing the dividend. It has to be used for the business purpose. So that has to be looked into it. And then it has other component is with respect to the arm's length benchmarking principle, that interest component which is being charged by the shareholder, is it at the arm's length? That also need to look into it, and we will talk about it when we talk about the related party transactions. And certain fines and penalties are not deductible, like RTA fines which is paid, or a VAT fine which is being paid. Those are not deductible expenditure. And then there's a limit of interest amount, which is the company which has a funding or borrowing from the banks. The limitation is 30% of EBITDA or 12 million. So earning before interest, tax, depreciation, amortization is 30%. So or 12 million. So anyway, earlier it was only 30% of EBITDA. Now there's an additional guidelines being provided that it can be claimed up to 12 million. And then tax on the income outside the state also, that tax is amount is not an expenditure. This is a tax which is levied by the government authorities on the profit, so that amount cannot be deductible expenditure. So yeah, so net interest expenditure, which is 12 million or 30%, and then it includes a lot of other components, like if you have a right of use asset, and then the notional interest being amount considered on that, that interest is also included in this limit. So generally, what chart of account changes would be required if you see, considering the deductible, non-deductible expenditure, generally in your operating expenditure. So certain input VAT non-deductible. So you may have to create a separate ledger code which are deductible and non-deductible, so that it helps you on easy computation of your taxable income. So entertainment expenditures, which are pertaining to your shareholders, partners, you need to have a separate ledger in that. Uh, entertainment expenditure pertaining to employees, because for employees you will have full deduction, whereas for if it is for your partners, shareholders, customers, it is limited to 50%. So separate account has to be created. Or any fines or penalties, generally it would be for VAT or other non-compliances, fines, penalties being paid, that should be under separate head code, ledger account, which is not deductible. Any kind of foreign tax credit, that is, you are going to adjust this foreign tax credit, is where, as I mentioned, that a company A LLC in the UAE has an investment outside UAE in Singapore. So any tax being paid there can be credited as against the tax liability in UAE. So separate account has to be created so that that can be adjusted against the tax liability. Then any other income and expenditures like dividend income, which are exempt, should be separately tracked, because that will be has to be reduced or adjusted against your accounting profit. Donations which are non-deductible, which are other than public qualifying benefit entities, and donation which are deductible, and finance cost, interest, we need to see if it is for the related parties, what is it in arm's length, and is it having a business sense where it can be deductible. So separate account code has to be created now, that changes has to be done. And there's other changes which will be required to comply with the corporate tax law. So now looking into what are the different transition provision, which will be implemented. I mean, once you start getting into this transition from now into corporate tax jurisdiction from 1st January 2024. So what are the transition provision to be need to be noted? Uh, the first is with respect to your closing balance sheet of 2023. And as it is going to be an opening balance for 1st January 2024, so you need to make certain adjustments. So your closing balance will be your opening balance, and there need to be certain adjustment to be done in those closing balance sheets. So we look at what are those adjustments to be done for an opening balance. The next is with respect to the arm's length principle for all your related party transaction balance, which is appearing in the closing balance sheet. So adjustments has to be done, and then if there has, because there would be some intergroup company transactions which are there and which would be appearing in your receivables or payables, that has to be reported as per the arm's length. That has to be reviewed and looked into it. And then there's another provision with respect to the anti-abuse rules, which the GAR General Anti-Abuse Rule has been in effect since the corporate tax law was declared in the month of October 2022. So any kind of changes in the structure, in the financials, in the group is being done just to avoid the tax and without any commercial substance that will be looked into by the FTA, and that could be taxable, and then notices can be issued. So whatever changes we do in terms of the structure or the financials, that has to be supported well for the commercial business sense. So just an example, like how a balance sheet would look like. You have an asset and then the equity side of it. So this, like the whatever 31st December balance will be, this will be your opening balance for 1st January 2024. So, but there are certain adjustment which has to be done with respect to your non-current asset, property, plant, equipment, intangible, goodwill. So we will see what are those adjustments need to be required to be an opening balance for 1st January 2024. So the first criteria, I know there are certain criteria to be looked into it. So what are the adjustments required is in the financial asset, liabilities, immovable properties, and intangible assets. Your financial assets are basically, if you look at the balance sheet, so financial assets are your investment securities where you have made an investment in other companies. So that is a financial asset. And also all the depreciable assets are your financial assets. So property, plant, equipment also covers under that. And your financial liabilities could be your any contractual liabilities which has to be paid. That is also a financial liabilities. And then intangible assets are your intangible assets could be patent, copyright, or goodwill. So what kind of adjustment need to be required in that we will look at. Or any immovable properties, which could be in the land and building. So those are the certain items which are mostly in the non-current asset. We will see what kind of adjustment would be required. So first is this need to be owned prior to the first tax period. So your first tax period is starting from January 2024. That's what those assets should be with the company prior to that. Those have been purchased in, 2023 or 2022, 2021. It could be in any period, but prior to the first tax period of 1st January 2024, that assets should be owned by the company prior to that. And then it should be recorded in the financial statement on the historical cost basis. So whatever the cost has been incurred, it should be carried on that historical cost. It should not be the market value every time you're putting in. So when there's a market value, you need not require to do adjustment, but only when it is a historical cost for which you would be need to do the adjustments. And these are going to be disposed of or deemed to be disposed of during or after the first tax period. So any disposal which should be done after the first tax period, then those adjustments need to be done. And the whole purpose is that since the corporate tax is effective from 1st January 2024, so you won't be paying any on the gain which you would have arrived prior to that period. So the value of that need to be adjusted. So you don't end up paying the tax, whatever the gain you would have earned prior to that period, prior to 1st January 2024, should not be taxable. And that's the whole logic of making this adjustment. So we look at the example, and then the gains are to be excluded, the losses when disposing of this has to be removed. And then and this election is made, this adjustment has to be made in your first tax period, first tax return. So the first tax return will be in your September 2025 for the period Jan to December. So when you're filing the return, that need to be notification has to be filled. The form is not a declare, but then there would be definitely a field that what kind of adjustment you're doing. You need to declare that in that tax return. So this is an example, like an asset which was acquired in 1st April 2020. The value is 1,000 dirham. And then on 1st January 2024, when starting of the first tax period, it is 700. And then if you see the market value on 1st January 2024 is 1,500. Okay, whereas the net book value was 700 in the 1st January 2024. Now, suppose if this asset is being sold in the after the first tax period, that is on 1st April 2024 for 2,000. So now if you compare 2,000 as a sale value and the net book value is 700, so you have a gain of accounting gain of 1,300, so which would be reported in your accounting income. But now are we going to tax the complete 1,300, based on the net book value and the sale value, it's not going to be that, right? So the tax amount will be based on the market value. So the market value is on 1st January 2024 is 1500, and your sale value was 2000. So the difference between your 2000 and 1500 is 500 is the taxable gain, right? And then what is basically the difference between your market value and the book value, 800 will not be taxed because it is pertaining prior to your first tax period. So only taxable will be between your 1st January market value and the actual sale value. So that is 500 will be taxable. So out of 1300, 500 will be a taxable amount. So you would do an adjustment for 800, which won't be taxable. And this adjustment is only done when you're actually selling that property or whatever the asset is. So there are two methods of for this adjustments. One is the valuation method, and another is the time proportionate method. So when we look at the valuation method, it's like what we're going to do is in this under the valuation method on the first beginning of the year, the 1st January 2024, we will do a market value of that. So the market value of that immovable property has to be, it will be taken based on the government authorities. There are certain approved government authorities who are eligible to do the valuation of that. So that valuation has to be done. If it's going to be sold in that year or subsequent year, it can be sold in 2025 as well. But the value should be considered as of 1st January 2024. So most of the organization who has the immovable property and they have a plan for disposal of that property in coming years, so they should be going for having that market value as of 1st January 2024. So it is 100,000, suppose is the market value. And then the second step is that we are going to have a comparison of the original cost versus the net book value as of 1st January 2024. So suppose if we're going to have this was purchased, suppose in 1st January 2020, the value was 6,000. And then on 1st January 2024, that is the beginning of this year, the value is 50,000. So whichever is higher is going to be the amount which is going to be deductible from it. So 60,000 is a higher amount. That is the amount we're going to deduct as a cost from the market value. So now if you look at the 1st April 2024 is the value where the asset was being sold. So we look at the previous case, it is 130,000. On the 1st April, the asset is going to be sold, is the value is 130,000. And the net book value as of 1st April 2024 is 48,000, whereas in January it was 1st January 2024 it was 50,000. Because of proportionate depreciation on that, the value has gone down from January 2024 to April 2024. It is 48,000. So the total gain is 82,000. So the sale value of 1st April we are going to sell it at 130,000. The cost we consider as a net book value as of the particular date. So the total gain is 82,000. So are we going to tax the complete 82,000? It will be shown in accounting income. So what adjustment we are going to do? So we will consider the value as on 1st January 2024 is 60,000, either of it. And we are going to do adjustment again that. So the market value on 1st January 2024 was 100,000. And then the higher of this amount is 60,000. So 40,000 is the amount, which is going to be excluded as from the gain. So the taxable gain will be out of 82,000, your 40,000 will be reduced. So net amount which is going to be taxable is 42,000. So out of 82,000, 40,000 is reduced. So next taxable amount is 42,000. The other method is time appropriate method. Now, under the time appropriate method, what we're going to do is we will take the similar approach of step one. We are going to determine the market value as of particular date of sale, which is 130,000. So the market value on 1st April 2024 is 130,000, which is the sale value. And then we will compare with the cost, original cost, or the original cost or the net book value at the beginning of the year, which is 60,000 or 50,000, in this case 60,000. And then this is going to be reduced. So the profit which is coming is 70,000. 130,000 minus 60,000. It's 70,000 is the profit. But this will be now, we have to take a time approximate method. So it is based on the number of days prior to this tax period. So this was uh, originally acquired on 1st January 2020. So from 1st January 2020 till the date of this, till the till the beginning of this first year, 1st January 2024, the number of days is 1461, and the total period from the date of acquisition till the date of sale is first Jan 2020 to 31st April 2024. It is 1552. So we are going to apportionate that. So the apportionate is 1461 divided by 1552, which is the total period on which the asset is held before the sale and until the beginning of this year. So which comes to 65896 on the 70,000 profit. So the taxable profit will be 130,000 minus 48,000, which was the net book value as on the date of sale. 82,000 was the total value of the sale, total gain. And then out of this taxable will be 82,000 minus 65,896, which is proportionate to the period until the beginning of this year. So this will be excluded from that. So this adjustment will be done when you are selling this property. So the taxable income will be 16104. And then for the intangible, this is for the immovable property, and similar is followed for intangible asset. But the only catch in the intangible asset is this cannot exceed more than 10 years. The period of holding prior to the first tax period should not be more than 10 years. So it should not be held, like if you say 24, it should not be held more than 23, 13, 2013. This asset should not be. So we'll only consider 10 years period. Now, in case of other qualifying financial asset and liabilities, we only use the valuation method, not the time apportionate method. So financial asset, as I was mentioning, it could be securities invested in other companies or any contractual liabilities could be there. So suppose the market value of this security, which is invested in other companies, is 100,000 as on 1st January 2024. And then the cost of this asset, which was purchased in 1st Jan 2022, was 60,000. So the gain which has to be excluded is your market value as on 1st January 2024 minus the cost of acquiring that particular asset on 1st January 2022. So the gain is 40,000. This portion is to be excluded. And if we take about the total gain which is appearing in this case, like 130,000 was the value of sale on 1st April 2024. The net book value was 60,000 and total gain is 70,000. Now out of 70,000, a portion pertaining prior to the first tax period is 40,000. So now this will be excluded. So the only gain will be 30,000. Again, this adjustment has to be done when the asset is getting disposed of. The other point which I was mentioning about the arm's length principle. So this arm's length principle is talks about the is a concept where you are having a transaction within the group company or connected parties or related parties. The same amount of cost should be applied while you are going to buy the same item or from the other parties. Suppose if you are buying any electronic items or trading electronic items being supplied by India entity to UAE entity within the group company, same group company. So the price which is at which it is being supplied from India to UAE will be benchmarked with a similar kind of activity, a similar kind of transactions in other companies with similar range. So there's certain database being used to analyze that pricing so that it is at arm's length in the market. So, here basically all the balance sheet items, which are appearing in the financials, where it is with respect to the related party transactions, then those need to be adjusted. So, 1st January 2024 balances, which could be in the form of inventory. It's like if I'm mentioning that electronic item being supplied by India entity and it is lying in the inventory. So we need to see what was the arm's length pricing for those inventory item. Any kind of adjustment need to be done, that has to be done. So suppose if there's inventory value of 100,000, okay, and when we compare with the market, that value could be 90,000 when it is done at the markets. A similar transaction is done from the local market over here, benchmarking to the pricing. So the difference of 10,000 need to be adjusted in the financials, in the opening balance of inventory. Similarly, any kind of receivables or payables which are there within those connected party related parties. So those transactions has to be benchmark or arm's length pricing transaction has to be done, and any differential has to be adjusted. And then the general anti-abuse rules I was mentioning, this is applicable from 18th October first. The law has been announced, and then the whole purpose was that business houses are not taking advantages of any kind of structural changes to bypass or avoid the tax. So that need to be looked into it, and also be supported with the commercial business reasons. So proper documentation has to be there whenever such changes are being brought in. And say, for example, if there is a clause of small business relief, a small business relief is applicable where your turnover is less than or up to 3 million. Now, to take that benefit, company may start having a splitting of their business, creating a separate legal entity where they can just park the revenue up to 3 million and try to take advantage of that benefit. But before doing those changes, we need to look at the commercial business sense. There could be like a company which is, if I say, electronic item being supplied, there's a distribution business that's supplying to the end consumer, and also there's an installation service section. Now, before 2023, they would have a combined business of both installation and service. Now, after 23, from January onwards, you want to have that different business to reduce to towards, your um, small the revenue up to 3 million. We want to bifurcate that. But before doing that, there has to be proper business as a commercial sense, and there's a separate guideline being announced for that, what has to be looked into it. So before doing any kind of such changes, all the guidelines of the law has to be looked into it. And another example is with respect to the qualifying activities. We know that distribution business is a qualifying activity. Now you're doing it from the mainland. Do we go and move to free zone to benefit out of that? That is again looked into the commercial business. And so case to case, it has to be analyzed whether it is supported well and what is the commercial business reason of shifting from your mainland. But it doesn't mean that you can't do this. You can do it, but there has to be proper documentation looked into it, and any kind of restructuring in the group which is done just to avoid tax. So those proper guidance and advisory need to be done, and documentation is ultimately the main purpose of this. Now, looking at certain connected parties, related party transactions, what are those, and how do we identify that connected parties transactions? Uh, so here is an example of saying that what kind of how does someone has a connect, or how someone is building up the related party. So it is based on, like, if a judicial person owns more than 50% of the interest, company A LLC is having 50% and company B LLC. So that 50% stake is creating a related party. And it is not only that a company A should have 50% more of investment, but it could be even if the company A doesn't have more than 50%, but able to control and make decisions. Because anyway, you have the group companies, the group company has like management services are under one particular LLC company or one entity, and then the business is being carried out through other entities. But that the LLC company is able to control, even that it doesn't have a investment of more than 50%, but is able to control the decision making. Then again, it could be forming a related parties. And it is not only limited to the judicial person or LLC companies or the private companies, but it could be also from the individual perspective. An individual who owns more than 50% or is able to influence or control the decision making. There could be a shareholder who is not in the business, who is not in the directorship of the business, but he is able to influence, or he's able to take a decision making on that. So that also becomes a related party. Uh, then, what is the definition of connected parties? So connected party is the one who is basically, is the owner of the company. Is an example, like an owner or shareholder is the connected party. He's like, and his relatives can be also like a shareholder A is the owner of the company, and his relatives could be his family, his extended family as well. Could be also a related party if any transactions is done with them, like someone who's supplying services in terms of car rental services is being done by a brother of the owner of the company. Then that is a related party transaction because he is providing services and who's related to the owner of the company. Then pricing need to be looked onto, the arm's length benchmarking has to be done for that. And there could be a director or an officer of the related, are also like, the the director and officer of the company are connected persons, because they are the one who are able to influence the decision making of the company. So they are somewhere related to the business and able to influence the decision making. So they are also connected persons, and then any kind of payment being done to them need to be benchmarked. So as I was mentioning, this is like a tree where you have a to fourth generation, a fourth kinship is the relation can be there with the parents, grandparents, and grandparents and great grandparents. So any kind of relationship, even brothers, sisters, are considered part of the related parties. We have example company A who is distributing the goods, selling the goods to external customers, company B for 20 dirham, and then it is selling to its own related party, like it has an investment in company C. Company A has investment in company C. They are related party, and it's selling the product at 10 dirham. So is it fair, or it is in the arm's length with the market? No, because generally it is a 20 dirham, but it is selling to a related party 10 dirham. So it is not, and this will affect your profitability, because you're reducing your revenue, you're reducing your profitability in the company. So that way you are going to avoid or reduce the tax liability. So that's the reason that it need to be at arm's length. And then for that, certain principles has to be followed, and certain benchmarking has to be done for all these transactions. And database are being used to assess the what should be the actual pricing for this. There are certain payments which are being done in terms of salaries or perquisites to the connect persons. So the owner maybe some until now would be just drawing a dividend from the profit, but now he would want to have the his salary to be put in, because he's also contributing to the business in terms of the time and the decision making, other business execution activities. He's part of it. So he want to have the salary or even payment being made to the directors or the connected parties who are influencing the decision making. So all these payments, salary, perquisite, rents, these all need to be benchmarked. What is the real price? What is the cost in a similar kind of business? How much is being paid to the other entities? And the other aspect is in terms of net margin need to be benchmarked to see whether after giving this salary, is it actually reducing your profit to the tax liability is getting reduced compared to net margin, what the other entities would be earning in the similar jurisdiction or similar size of the business. So that need to be benchmarked, and there has to be proper documentation supported, because later on, the FTA may come and do an audit, and they would ask for this documentation. So that need to be supported well. And here are certain examples, the services, for example, like, the most of the companies in the group would have like the head office or the main company, parent company P is having a contract of Etisalat for the telephone services, and that's being used by A, B, C, the other group companies. So the contract which is there with the main group company could still continue, but then there has to be basis of cost allocation, and that has to be documented well, the how the cost is being allocated to the ABC company based on the revenue or whatever the mode or headcount or whatever the reasoning or logic has to be there. That has to be documented well. So in the transfer pricing, there's a concept of those which are pass-through cost, the cost which is not adding value, and this is just being, it's kind of a reimbursement. So if you see the telephone services is a reimbursement, so we don't add up any kind of markup in this. This will be charged what is being charged by Etisalat, but the cost allocation basis has to be done, and that has to be documented. And then centralized finance function, this is a low value added function which companies, most of the company would have, like finance function or IT function or HR functions. Those are something which are centralized and being provided within the group companies. So how the cost has to be allocated, the basis of allocation need to be documented for the charging to different group companies. And there could be other cases like the employment contract. Companies generally would have that is the employment contract. It would the visa is under the company A and is working for company B within the group. So the cost which is being charged from company A to company B, the payroll is being processed in company A. It can be charged to company B, but there has to be proper documentation supporting for this. And then salary payment to owners or connected parties, as I mentioned, it has to be as per the arm's length benchmarking principle. Then, like for example, an electronic supplier in India having a setup in UAE for distribution. So whatever rate it's being supplied from India to UAE has to be benchmarked as per the transfer pricing policy documentation. And similarly, could be some kind of financing arrangement where the loan is provided by the group entity to other entities. The rate of interest, it has to be benchmarked with the bank rate, which is being currently practiced, so that whatever the rate is being charged, the whole purpose is that they might charging higher rate of interest to reduce your profitability and ultimately impacting your tax liability. So this amount, whatever is being charged, need to be benchmarked with the market rate. And this is a summary of different services, or the activities which are among the group company or the related parties, as I have described with the different examples. Now, in terms of the accounting record keeping, what are the accounts record keeping we need to have, and what is required under the corporate tax law. Now, there's a concept, as we know, like it's basic, that it could be either cash basis accounting or accrual basis accounting. So cash basis is being provided if the threshold of annual threshold is not exceeding more than 3 million. So which are small business entities which are there, SME segments which are there, which doesn't have a revenue exceeding 3 million. So they can still continue with the cash basis accounting principle, where they would just record revenue or expenditure based on the receipts and the payments being done. But otherwise, other than these entities which having a revenue more than 3 million, they need to follow an accrual basis accounting. And as per the accounting standard in UAE, it's generally the IFRS being followed. So all the entities need to follow IFRS as an accounting standard. But there is, those companies which has a revenue not exceeding 50 million, they can still apply. I mean, they need to apply the IFRS, but there is a specific section of IFRS for SMEs, where there are certain provisions which are eased for those SME sectors, which has a revenue less than 50 million. But overall, every company need to comply with this IFRS. And that's the reason one of the, when you are transitioning to this corporate tax jurisdiction now, so all the entities need to see how their financials have been prepared. Have they been complied with the IFRS requirement in terms of your revenue reporting, or lease reporting, or other items in the balance sheet? Is it being reported as per the IFRS? Because that will be your opening balance sheet for 1st January 2024, and your tax liability during this year will be derived based on those financials. So accounting standard need to be complied, the IFRS need to be complied with that. And in case of the group companies, though, for the group companies, they need to prepare like ABC and parent companies. Their ABC need to prepare their own individual standalone financials, and then for consolidation purpose, when they're consolidating that financials, so any group company transactions are there within that group, those need to be netted off, those need to be squared off. This would be removed, eliminated, and then the consolidated financials has to be prepared. So the first is the individual financials of those companies to be prepared. And for calculation of the tax liability, those need to be consolidated, and you derive your tax liability. And the tax grouping and others, we can take up on the separate session on this. Now, there is a concept of realization and unrealized basis. When we are following this accrual basis of accounting, the realized is basically we are booking is not on the cash basis, but we are booking it based on the accrual concept. So now, in case of certain items which are there in the balance sheet, which would require fair value or impairment accounting, those are like immovable properties, machinery, and equipment which are there in your financials. If there are any changeover happening with that, so now if you have, suppose as on 31st December 2023, there's an asset of 100,000. 100,000 is there, but when we compare with the market value, the value has gone up for that particular item, and it has gone to 120,000. So the 20,000 which is increase in the value of that asset, you are not actually selling that item, right? So you're not realizing that value. So you cannot go and increase your gain out of that, because it is not being sold. You're not realizing that. That's the reason you cannot go and have that accounting income being reported. So those are just a notional basis where you're comparing with the market. So all this, and it could be other way around also. Impairment is an asset value which is there, and you see it is depreciated, and the market, it is in the book value, it is being shown as 100,000. Now, when we compare with the market, the value is gone to 80,000, right? So there's a reduction of 20,000. Are we going to claim as a deductible expenditure for those 20,000? No, because you're not sold, you're not going to sell this item, right? It's just a book recording. So this is not realized. So that will not be reported in your financials. I mean, you cannot, if you would have done for accounting purpose, but for your tax computation purpose, you're not going to reduce that. And the capital account are basically those which are not in trading, are not, which are generally eligible for your, like it could be any equipment, machineries, plant equipment, which are there, which are, which are not being sold. It is used for the business purpose. You would claim depreciation. So these are the items on which you are using only realization basis. When you are actually being sold, when you're actually selling that item, then you can only account for income or losses for that. But now unrealized basis in case of revenue account, that means you have inventory books lying in the books, and if you think that you want to create a provision because those are like old obsolete items and they cannot be used, so you need to want to create. So there's an inventory of 100,000, and if you're going to create a provision of 10% of that value, which is 10,000, so that provision which is being created can be deductible expenditure, because that is for your revenue account, that is for your business trading and day-to-day operation purpose, because that you may sell it off in the near future as well. So that amount can be deductible. So similarly for your provisions on the receivables, which is there, that provision which is being created is also a deductible expenditure. Now say for example, you may have a case that in 2023 you have created a provision and a bad debt has been created, and you recover that bad debt in 2024. Are you going to record that income in 2024? So as you have already claimed the deduction in 2023, so now when you're getting that as an income, it has to be reported, and that will be continued. That practice, as part of unrealized basis will be, that income which is reported will be continued in the next year, so that it will be accounted thereafter. And the period for which this accounting record need to be maintained is for 8 years. That means 7 years plus the current year. The total is the 8 years for which the accounting record need to be maintained. And in VAT, we have 5 years. In ESR requirement, it is 6 years. But now it is the maximum period, which is not as per the corporate tax law. So most of the financial records supporting has to be maintained for 8 years. And what is the audit requirement? So the audit is required for the value exceeding 50 million. So, it's mandatory for the financials to be audited, which is value more than 50 million of turnover. But it is always advisable, as there are certain compliances in terms of having reporting as per the accounting standard of IFRS and other regulations. It is better to get a financials reviewed for 2023, even though they could be less than this limit as well, because you make sure that your financials are being prepared in compliance to accounting standard and you are ready for the corporate tax requirements. And all the qualifying free zone, for the qualifying free zone, because they are claiming the specific exemptions or 0% corporate tax, so their financials need to be audited as well. And then, when we have this documentation requirement, as we have seen in the VAT, there has been non-compliances penalties. Similarly, we have for the corporate tax as well, the penalties are there for different non-compliances as well. And in terms of the accounting records, what are those accounting records to be maintained? Is it like balance sheet and profit and loss account, the basic, which is in the financials? Then all the records of the wages and salaries to be maintained, the records of the fixed asset, the inventory records, and then the stock records. So, I mean, if you see, the whole purpose is that your whatever you are reporting in your financials, whatever expenditures you're claiming in, what deductions are there, anything which is part of your financials, and then are being, because these are being required, your tax liability is being computed on your net profit. So to derive that net profit, you have done certain adjustments, certain record keeping has been done. So those has to be supported well. So now with the corporate tax, the documentation is becoming critical, and so you need to maintain those financials, and you can do it as a manually auto system, but a process has to be defined well that you are keeping those account records. And this can be in terms of invoices, tax invoices, any elections or determinations by the business houses or related party transactions, wherever the benchmarking has to be done, that needs to be supported. So all the related party transactions, which has to be as per the arm's length principle, there has to be proper documentation and supporting for each of those, because when it comes to audit, and FTA can come do an audit, and they would look for all those documentation supporting. So it's always better to be ready from the year one, when this tax is implemented. And it could be maintained in English, and if requested by the FTAs, they need to be translated in Arabic. But the preferred is that it has to be maintained in English, and then as per the requirement, whenever asked for, an Arabic translation can be done. And then in terms of the administration requirement, what we have is that yes, all the business, all the LLCs or freedom entities need to be registered. It is mandatory. And then the return filing is there's one annual return to be filed after 9 months from the end of the financial period. And in terms of there is no threshold limit defined for the businesses, but for the individual, for the individual who are doing the commercial activities and their revenue turnover is exceeding 1 million, like who are doing consulting services or freelancing services in the individual capacity, and those are commercial activities and their revenue is exceeding more than 1 million. For the individual, there's a limit threshold of 1 million and above, but for the business houses, which are agencies or any private companies, be in mainland or free zone, that need to be registered. So you may say that you don't have a taxable income. Do I need to register or not? Yes, you still have to register, even though you don't have a taxable limit. If your income is not exceeding 375,000, you have to, because you have to declare that income, right, in your tax return. How the authority would know? Only when you register and filing return. And then has to be one return for the tax period, yes, annually, and 9 months thereafter. And it could be in the form, the electronically record can be kept for that. And this is just an overview of how how you do an adjustment. So you take your accounting income, and then as we have seen several provisions, that adjustment has to be done with respect to your exempt income, which was included in your accounting income, that need to be reduced, and certain expenditures which are not allowed or disallowed need to be adjusted, or with respect to your related party transactions or group company transactions, that need to be adjusted, because there is when you do an arm's length benchmarking, the pricing has to be, there would be some adjustment required with that. When I was saying, for example, for inventories, so that value of electronic item which is being traded from you India entity to its entity in UAE, so the arm's length benchmarking differential has to be adjusted. Any kind of unrealized gains and losses, as I was mentioning about, your financial assets, your liabilities, your capital account, which are not on realized basis, that has to be there, that has to be adjusted. Say, for example, your exchange losses for your asset items which was purchased, and that there's a difference of, so that is not realized because the payment is not made, so that exchange differences has to be adjusted here. Any tax, then you derive your taxable income, and then you pay a tax liability is computed. Then like foreign tax credit or other reliefs or withholding tax, which is those has to be reduced from your tax liability. And then there is basically a business restructuring relief, which is specifically when you have that group companies and then you are buying another company, you're taking over other company, there's a restructuring relief specifically provided, that need to be also adjusted in this. So now the key areas to summarize what we need to look at is the pre-tax regime. We need to look at how is the current setup, the structure. If some of the entities which has a presence in free zone, whether they meet up the requirement of substance, in terms of their adequate number of people around, the business activities being carried out from that. And then look at overall, we need to see whether, of course, the first is that we need to get registration individually. Each of those entities need to be registered individually, and then they can form a group. So whether to form a group or not as a tax group, what is the benefit they get, those need to be assessed before getting into the grouping of those entities. Then, of course, we need to look at the related party transactions within the group. What are those payments being made to the connected parties or within the group company, the transactions being involved, that need to be identified. And identifying any exempt income which is there, because that need to be adjusted in your accounting income. And we need to see the corporate tax impact on the cash flow, the profitability, the structure, where it is, the chart of accounts need to be looked into it, and other provisions which are there in terms of whether you have any income outside UAE, is it being taxed or not. So yeah, so on all these areas, our team helps, we look into this assessment, and then we also provide a corporate tax training with respect to the individual business houses wherever it is required. And what we also do, carry out a mock assessment of your financials, existing financials. We review it, we see the structure and compute the tax liability based on current scenario as a scenario. And then we identify or we recommend certain changes in the group or in the financials, and then recompute the tax liability and see that what is the difference coming in prior to that adjustments, how what is the tax liability, and when we we actually implement those changes in the business, what is the tax liability, and then we recommend that, and based on the comparison you can make a decision, okay, whether to go for those changes, does it make a benefit to the company or organization. So yes, as part of Besat and Beyond Consulting, we can help you on this impact assessment, carry out a detailed analysis based on what we are understanding your financial structures, your corporates, your financials, the structuring, and then support on that implementation part of it, and then we definitely help you on the compliances framework after this implementation of that support functions. So what we can we have a next session on the automation, how the automation can help. So maybe what we can do is we can do we have questions? I think we.
Yes, we do have.
So I think what we can do is basically we'll just run through the automation of reporting, and then maybe thereafter we can take up those questions altogether.
Okay.
Okay, so let me share my screen without wasting any more time. Yes, welcome to session on automation and reporting. Basically, I will first try to answer three questions. First is what, then is when, and third one is how. Okay, RPA is not something new. It was there since very long time. In fact, it was there since 2000. I mean, just after 6 years after I was born. So, what is RPA? RPA is basically a software bot that mimics human actions. So, they didn't, require any changes to your existing system because they are just, put on top of your existing ERP systems. So, what is the benefit? Like it is scalable. Okay, once we design any RPA a script or any project, so it can accommodate any a number of transactions, and it is fast and it is error free. So basically, um, when we try to design any RPA project, so what we do, we make it scalable so that any in future any additional changes which are required that can also be accommodated. So now second question is when when we should look for an RPA solution. So right now corporate tax is getting introduced. Okay. So is there any activity in any of the tax reporting which is high volume or whether it is repetitive? Is it a rule based or if these conditions are met, if the inputs are digital, for example, let's say you don't have an existing ERP system, so your books of accounts are not digitized, so then there is no point in developing an RPA solution because the preconditions are not there. So understanding when is very important. So now we learned what, then when we learned when, and now let us see how. If I want to do automation, okay, how do I can do that? First one, like RP, if you are having a legacy system meaning, it cannot be integrated through an API in the sense it cannot be integrated to a direct connection. So there is a user who is sitting in front of the system who will be entering his ID password, he will be navigating to a place, and then he'll be downloading the report. So this is basically a human doing it. Okay, look at RP how it does. So RP exactly mimics a human action. It will log into the system, it will navigate to a different section, then it will download the reports which are required for, let's say, for VAT reporting. Okay, all the reports are available. Then which are the other tools which I can use right now? There are many things which RP cannot do. So there are custom scripts are required. For example, if your data is in a image format,
Thank you.
okay, so this image, directly it cannot be consumed. So you have to do some pre-processing. So you can use AI on top of your RPA. So AI, what it does, it will take out the information, then it will generate a data for you that can be assessed. So now I'm going to show you certain case studies which I have developed because I have been using RP. I'm hearing some noises. Can everyone be on mute, please? Thank you so much. So basically, I started my journey in almost in 2019. Basically, 2019 I started into RPA. Then continuously I was working on a lot of RPA projects. Before that I was in internal audit. So internal audit, it was more of a post-mortem. Like after the incident is done, I'm reviewing the systems control. Now I want to automate. I want to find out what is the problem even before that happens. Let us say in case of VAT, okay, even before I am filing my VAT return, I want to know whether my data is accurate, what are the exceptions which are unreported. So in order to do that, I have initially created one VAT automation tool. So basically it was interacting with the Oracle system. It was accessing all the reports which is required for VAT reporting. It is doing all the processing, and then finally it is preparing a report. Right now on live, I will not be able to show that, but I can show you a mock-up like how it can work. So basically, this is the tool which I had created that time. So here you can select which entity you want to file your or want to prepare a VAT return. If I select all, it will run for all the entities. If I select a particular entity, then it gives me an option to select for which period you want. Okay, let's say here I will select from December to 31st December, and if I hit run, so it has prepared, but right now that connection I'm not able to establish. So as you can see in the backend, so that's why I'm just showing you the mockup. Okay, if the data connections are available, so there are more than 5,000 codes which runs in the backend, which does all the validation checks, whether the place of supply is correctly mentioned. It will do the grouping, and it will finally prepare a VAT report which is in line with the requirement. Second case study, I can show you live demonstration. So basically in this case also, it is performing a GST reconciliation. This script is prepared in Python, and I have used pandas and numpy packages to do this. So in this particular automation, it does reconciliation in less than 1 minute. Okay, I can show you this live demonstration. So basically, as I click this one, so it will start accessing the Excel file. It will start doing some pre-processing. Okay, now it is processing the first ledger, which is GSTR1. So it has all treated all the null values, and it has changed the date format. Then it has done some pre-processing. It has done some data cleaning, and it has already performed
Right.
38 and more than 60 actions. It's already performed, and finally it is performed the reconciliation, and it will show the final output. I'm not anything, I'm not doing anything right now. So the program itself opening the file. So there you go. It has opened the Excel file with the reconciliation. So this is the speed at which you can also perform reconciliations once you know what are the ways in which you have to clean your data. Okay. Now let us move to the next one, which is our favorite topic today. Manish has presented really well, and I can understand, the depth of his knowledge. So he didn't stop anywhere. He was so confident about corporate tax. Similarly, I have also someone who is an AI companion who is also expert like Manish. So let me show you you're able to see my screen, right? So I'm showing you basically a Copilot, which was introduced very recently. Microsoft has introduced Gemini, which is an AI model in which you can actually process all your PDF documents. So if you have your PDF document, you can just go and click Ask Copilot, and you can ask any question to the PDF. So it will go to that file, and it will give you a summary of that information. So I'll just open the chat box to see if audience has any questions. Okay, and I will ask that same question to the document. Let me open the chat. Okay, can you ask any question relating to this? Or else let me ask some general question. Okay, like what is the due date for filing return in document. Okay. So as you see, searching your page for information. So right now it is actually searching this page. It started preparing the content. Yes, it is now. So this is article 371, and it also tell you in which page you can find. Okay, as I click, so it is directly taking me to that particular page. Okay, I will ask one more question. Like, what are the penalty provisions? So again, searching. If I don't provide this document, then it will go to the web page and then it will find out the answer. So this is the penalty. There are two penalty clauses. In fact, there are multiple. Okay, so basically from this document, it is actually giving me the exact information what I need. So this is actually working with one document. Okay, let's suppose you have multiple documents and you want to, create a bot which can answer any question relating to that one. So for that, what you have to do, you can use something called as custom chat GPT. Okay, let me show you that also. Yeah. So basically, like this, you can create your own GPT. So here, basically, I have created one chat GPT which answers any questions which is relating to UAE VAT. Okay. So these are the documents which I have uploaded. So it will refer to all these documents and it can answer any question relating to this particular document. So let me, so if I just ask this question, so now it is asking and answering this question based on the inputs I have provided. Okay. I can make it more customized. In fact, I can, if there are certain API configuration can be done, I can add new action. I can do that also. Okay. So let me proceed to the next case study, which is using intelligent data processing. So sometimes it happens, right? You will not get the invoice in the exact format which can be processed either by a human or by a bot. Okay. So now in this case, this is basically a scanned document. So in order to process this, what I have used GPT-4. Okay. So I'll show you that quick demonstration how you can use GPT. So let me start a new. Okay. Let me open a blank screen. Let me attach some one invoice. Okay, I have some few invoices. Let me start with this. Okay, I have uploaded my invoice and I'll ask, I need invoice date, amount, details. Okay, like this I can ask the question. I can upload the image. Now GPT is actually extracting all the information. Okay, and it will show it to me. So as you see, it is actually able to extract the information, and this information it can be used for further analysis. Back in maybe 5 years back, was using handwriting recognition. Like I was creating an AI model to do that. Now all these are gone. Now even GPT is capable of giving you much more accuracy, which earlier was not possible from OCR. So in fact, the same example I have used, but there are certain limitations. Okay, I will give one more. I will show you one more invoice, which is very like text basis, textual based one second, which is this one. Okay. See, this is handwritten. Okay. Even for a human also, it is very difficult to read. So let me try if AI can, generate some inputs from this. Okay. I'm going to pass this invoice to the AI. Let me ask what is the, or can you all the, okay, I'm just giving a general sentence. See, still it was able to perform a good processing, like it was able to extract the invoice number, the date, and also the items. But if you see the first one, okay, there is no unit price actually. The amount is coming in the top. Okay, so let us see what is the VAT amount. It says the VAT, the amount is not clearly visible, so it doesn't, it was not able to perform well in this particular case. So there are few limitations are still there, but it is actually, doing well as compared to how it used to be before. Finally, my favorite Power BI dashboard. Okay, right now you have all your like GL, all your balance sheets or P&L, everything you have in your ERP system. You want to see a quick, overview of how your business is performing. So in this one, you can use Power BI. So I'll show you a dashboard. So let's say this is a like demo dashboard. Okay, so benefit is you can just click to the slicer and you can get an overview of what's happening in your different entities and different financial year. So you can slice and dice the data and you can see overall report. If you want to see the balance sheet, you can see that. If you want to see the income statement, you can see that as well. So basically, that's what I wanted to cover as far as automation in reporting is concerned. So if you want to know more about this, you can scan this QR code and you can directly connect with me and you can ask me questions. That's it from my side.
Thank you, Pradeep, for sharing about how we can use an automation and the tax and other form of reporting. So I think we can take up the questions which are there, which has been posted and the group. We see the chat box, certain questions being put up on that, and we can talk about it. So I will just read out. I mean, I think the first question which I see is deductibility on the bonus. Is the bonus being deductible expenditure when it is being paid to an employee, though it is not part of the your original contract with an employee? Yes, as I mentioned, that it is a payment which is made to an employee. It's for the business purposes, business expenditure being incurred. And also it's part of a compensation, though it is not fixed. It is a variable which would depend upon the company performance. So any payment being made to the employee with respect to salary or bonus or any other incentive which is based on the sales or anything is a deductible expenditure. uh, so Ankita, can you read out any other questions which you have seen in that?
Yes, Manish, there is one question on payments to owner. How do we benchmark?
Yeah, I also see these questions being there by as by multiple people. So payment to the owners is basically shareholders, or it could be any connected parties or related parties. So it could be in the form of salaries being paid. So that, how do we benchmark? It would, I mean, as I've seen that certain people have also tried to respond to this question. That is basically, we'll have to see what kind of job responsibilities that owner or the individual is performing in the so there has to be a functional risk analysis of the responsibilities being performed. It has to be documented. And then other is that it is not only the job descriptions or the responsibilities being performed, but it also depend upon the net margin the company is earning. The benchmarking is with respect to the net margin the company is making. That has to be benchmarked in the similar range of size of the company in the jurisdiction within the Middle East. That need to be benchmarked. And then there are the several criteria which need to be documented, to make sure that all the criteria, all the documentation is well maintained. I mean, it's not that today I want to draw X amount of salary. Is it X minus one or X plus one? What should be that amount, a reasonable amount? There has to be a range which will be worked out when we document all the criteria. And then, of course, the benchmarking could be only with respect to a similar kind of responsibilities, or with the other I mean, consultants, like those the job consultants who does the recruitment. The database from them can be also taken for those particular roles. What is the salary range in the market? That is also one of the input being considered. All the criteria need to be documented well. Yeah. Other questions, Ankita?
Thanks, Manish, for answering that. There is another question around how we identify if director is connected.
A very good question now, because definition of relationship with the directors is as such not defined. Now, do you call an executive director or even a CFO, a CEO of the company as a connected? That also, I mean, it's not about, they might not have an investment in the company, they might not be owning any stake in the business. Are they still connected? So that depend upon how much they are able to influence the decision making and how they are related in terms of, because some of the directors may have their incentives, their profitability, I mean, their compensation structure linked to the profitability of the business the company is making in, and they are able to contribute to the business decision making. Now the owners generally give a kind of authority to make all the business decisions and take whether to go for a particular business line, or stop over or get into new market. Everything's like they are the one who are deciding. So when they are able to control and influence the decision making, that need to be looked into. But specifically, FTA has not yet clarified, like, what is that directorship. But yes, based on the interpretation or understanding, it is the control which that director is able to make, or the decision making influencing that is able to make, that defines its connection to the business. Yeah.
There is one add-on question to bonus. That is, bonus to partners also deductible?
See, the bonus to the partners is a payment to the shareholders now, right? So any kind of payment, then it is deductible as a salary being paid to the shareholder. It is similar in line with the salary payment to the owners. The bonus is deductible, but then it has to be benchmarked. It has to be a proper documentation supporting, and just commercial justification has to be documented well. So there needs to be arm's length principle being followed for that bonus and for the salary being paid to the partners or the owners or the shareholders.
Okay. There are few questions related to withholding tax. Can you elaborate further around that particular topic?
Yeah. So what is the withholding tax? I mean, it is the tax where, I mean, the entity which doesn't have a physical presence, like, maybe a company, ALC, which is in UAE, is having a business in Saudi. Okay, they don't have a branch, or they don't have a physical presence. So whatever earning they are getting from Saudi Arabia, there would be a withholding tax being deducted as per the laws of the Saudi Arabia, or it could be in Oman as well. There also they have a withholding tax. So you don't have a permanent setup, a business setup in terms of the fixed establishment there. So whatever earning, then the payment being done to you is deducted. 10% could be withholding tax in Oman, or whatever the rate could be. The amount of tax which is being paid on your earning in Saudi or Oman, that get deductible. That can be a tax adjustment which could be made. So the liability which you derive on the tax liability, if now 50,000 is your tax liability, and if you have paid 10,000 as a withholding tax, another entity that can be outside UAE, that can be reduced from a 50,000 liability. 10,000 can be reduced. Of net liability is 40,000. But you need to get that withholding tax certificate to support an evidence that you have actually paid the withholding tax in that country. Yeah.
Okay, there are many more questions coming up. So there is one question around salary in a civil company wouldn't be deductible, right? Given there is no separation of legality for taxation.
Yeah, so civil company is not a separate from the business. As I was mentioning, that there is a concept of natural person or legal person. So civil company is in the similar. I mean, partners of the civil company are the same as the owner. So that ways they have to separate business. So separate entity has to be maintained. So taxability will be in the hands of the individual because they are running the commercial business. So civil companies will not be taxed as such, but the individual who is drawing it, they will be taxed on that amount because the business is not separate from the owner in that scenario.
Can aircraft repairs by a free zone entity be exempt?
See, again, that would depend upon the qualifying activities, as we have to look into it. What are those qualifying activities? And then, as we have mentioned, that it is regarding the international transportation, whether it be a ship or a air by air. So any activities which is being carried out. So that if that falls within the qualifying activities, that need to be analyzed. That transactional has to be looked into it. We cannot comment directly saying that is it a qualifying or not. But there are other scenario or circumstances need to be evaluated before coming to any conclusive decision making on that.
Um, we are running short of time. I will take last two questions.
Mhm.
One, is the interest carried forward to the next financial year if it is more than 12 months?
Yes, so it can be carried forward up to 10 years. The interest which is not deducted in this current year in 2024 because of the limitation of more than 12 million or 30% of your EBITDA, whichever is higher, it can be carried up to 10 years. Yes.
Okay. Pradeep, last question I have for you. There are so many automation tools around us. As a fresher, how one can start using those? And that is
Wow.
something we all want to know.
Thank you so much. So basically, we should have a knowledge of one RPA tool. There are multiple RPA tools available in the market. The predominantly what I feel like, I have worked on multiple RPA tools. So Power Automate is something which I can recommend where you can, it's basically citizen developer, like anyone can start learning that and start using that, and at least knowledge of one programming knowledge programming language like Python or R. So this will basically will help you to prepare certain scripts which cannot be solved through RP or through the tools which are readily available in market. Third one, and the most, learn AI, because AI is going to help you a lot, and it has helped me a lot, made creating a summary of a document, summary of a meeting, or creating codes, or reviewing my code and giving a better solution. So I use AI a lot. So knowledge of how to use AI, not how to build an AI, but how to use an AI is also very important. And also any one business intelligence tool, like you can maybe look for Power BI, which is easy to understand, and of course I can help you with that as well.
Thank you so much, Pradeep. I see there is one question that is coming up on repeated. So we are just taking last question since considering we are short of time. There is one question, Manish. In contracting, mainly the revenue is recorded as POC basis and the base in forecast cost to complete. How the CIT would treat a particular project which was at 10% profit until 31st December 23 and loss in 24 by 2%.
I see this question is coming from Mr. Mishra. So I think we have to talk separately about this, and then we need to understand the transactional, how is the transaction being documented and what is the basis of that. So we can connect and discuss about this specific, because this is a specific scenario based question. I think that is not for general. So I think we will just connect with you on this. Thank you. So I think thank you all for patience hearing about our session, and it is wonderful sharing our knowledge and experience and the corporate tax. And we our team, our expertise, and we do provide the services with respect to the tax assessment planning, and then the structuring, how that has to be in line with the corporate tax requirement, the laws, then on the implementation support. And we also have support on the transfer pricing, arm's length benchmarking. We support on the database benchmarking wherever required. And beside that, we have other services line on the technology services, as Pradeep has been talking about. He does the lead on our automation and technology services, and then we have business advisory, financial advisory services, and the auditing services. So thank you all again, once again, for your patience hearing, and we will share this presentation, whoever has registered with us, we will be sending an email on this, and we are happy to answer any other questions which you have. We can drop us an email, and then we can be addressing on those questions one-on-one, and we can connect on further understanding of specific requirements. Thank you.
Thank you, all of you.
Thank you.
Thank you.